It indeed is the big story that we are tracking at the top of this hour. In moments from now, the government will release the retail inflation data for May, and the expectations are that prices will indeed rise, particularly led by high food prices. Remember, pulses had gone up sharply, and so has fuel in the spirit. And we're joined by a very eminent panel led by our consulting editor Mythili Bhusnurmath right here in New Delhi. We've got Shubhada Rao, we've got Rupa Rege, we've got Manoj Rane, and we also have Jayesh Mehta. Thanks each one of you for being with us. Those are, of course, expectations. The data will be out any moment now, and we have seen prices inch up, and that ebb in prices has been interrupted. Mythili, to you then, 5.5% is above the RBI's comfort zone of 5%, and yet a lot of noise in the credit policy that just went by on retail inflation, or expectations of inflation going higher, even though they say we maintain the accommodative stance, but there is an upside bias to inflation. Your quick take on the numbers that at least we're putting out as per our polls suggest 5.5%?
Supriya, 5% was for the beginning of 17. And in India, we have seen seasonal ups and downs in CPI inflation. So I wouldn't get excessively concerned, even if it comes in at 5.5, because most of the increase will be driven by food inflation. And that's largely in the government's domain. And provided the government manages its food economy well, and we have normal monsoons, inflation would come down, and I would not get concerned even at a 5.5%.
All right, not concerned at a 5.5%, and largely, okay, that's breaking news on your screens right now, and it is a lot higher than 5.5%. At 5.76% is where May CPI is. That's versus our own poll of 5.5%, and 5.39% as far as the April figures are concerned. Shubhada Rao, if I may get this to you, 5.76%, does that make you a tad uncomfortable?
A bit uncomfortable because although we were much higher than the poll, we were at a 5.67. So clearly the price pressures that we had seen building up in items like vegetables, in cereals, in pulses and in oil seeds, rather edible oils, I think all of this is now showing a much faster momentum than even we anticipated. Add to that, you also have the fuel dynamics. In rupee terms, month over month, the Indian crude basket had also jumped about 14%. So, of course, the primary driver of inflation was anticipated to be food, which obviously seems to be the case. Vegetables had significantly moved up. Even cereals, which were showing until last month some softer momentum, had picked up in May as per our high frequency numbers. We'd also seen pulses, which in 2 months ago had been in contraction zone in terms of momentum, had since last month in April, remember, pulses had moved up very sharply, and we had anticipated that pulses would keep up that momentum. A prolonged and more intense monsoon definitely has had summer has had a very clear role to play in the prices remaining firm and gaining momentum very clearly. But as Mythili was pointing out, hopefully if the monsoon rains do not disappoint in terms of timing, whatever sharp uptick we are seeing in inflation primarily on the perishables should hopefully begin to see some disinflation in the second quarter. We still await the details though of the granularity of the drivers of inflation.
We will just go across to the granularity in much more detail, but important to point out to my viewers here that food inflation has actually spiked by nearly 7.5%. So some of the concerns that RBI perhaps did raise are valid, and I will take it across to Rupa Rege. And Rupa, like Shubhada was pointing out there, the constituents, whether it's pulses, whether it's edible oils, whether it is fuel dynamics, everything pointing towards an uptick, and you have seen that number settle at 5.76%. I'm given to understand that this is the highest since August of 2014, and one of the constituents and a key constituent there is food inflation, which is at an uncomfortable 7.5%. Rupa, your quick take on the numbers and of course the internals that we've just given you as far as food is concerned. It is at a 9-month high actually.
This is quite worrisome because if you see for the month of May, actually the base effect was quite favorable, because last year May, it was immediately next to those unseasonal rains and hailstorms which had created seasonal spikes in food inflation. Over and above that, such a big growth is definitely worrisome, and partly the heat wave, but partly also the shortages, they have been contributing to this. And I feel that June food inflation number is going to be uglier, because that time base effect will also be unfavorable. A, and B, since May we have seen huge spikes in vegetable prices and prices of sugar, wheat, all critical and major commodities in household consumption basket. So it's definitely a worrisome situation.
It is a worrisome situation, and what worries me more is perhaps one of the statements that you made, that June is going to get even uglier. Manoj Rane and Jayesh Mehta, as I bring you this question, Manoj, I'll let you have the first take on this one. June could be uglier, but May is ugly as well at 5.76%. Are you somebody who's losing a lot of sleep over these figures, or you believe this was in the making? One saw this coming because obviously food and vegetable prices would have spiked in the summer months of May and June. And you're not somebody who's overly worried about this.
So like my fellow panelists, the economists mentioned, one doesn't track it that closely. But anecdotal evidence was fairly clear. You go to the market, you see tomatoes are sharply up, you see egg prices are up, pulses are up, cereals are up. So, I think this number wasn't really a surprise. That June is going to be worse. I think people will have to sit back and take a look again, but I mean that's a good point, that the base effect actually was worse for June. So to that extent, I think food inflation does worry. The positive, of course, is that there are still positive predictions on the monsoons. Hopefully the monsoons should help food prices come off in the foreseeable future. I think there is also a bit of a positive in the sense that the bulk of the increase here has come from the food side on the prices on food. So to that extent, if food does come off, then CPI should start behaving itself over the next 2 to 3 months. But having said that, I think it gives further credence to RBI's point last week at the time of the policy that inflation, CPI is indeed a cause for concern. And from our point of view, I think the market point of view, really speaking, any expectation of rate action in the foreseeable future is that much later.
It's also important to point out to our viewers here just exactly what are the numbers and what are we talking about. I mean, vegetable inflation is at 10.77% versus the same figure at 4.82% on a month-on-month basis. So we're not pulling rabbits out of hats here. We are actually giving you real data and how that has resulted in that spike. But like Manoj was saying, there gives some amount of credence to what the RBI had voiced concerns over. Jayesh, let me bring this to you. And I'm going to be a little, off track here. I'm not going to just discuss the figure from you. But a lot of expectations is, and all our 4 panelists before you did say, that monsoon could see the picture improve. My larger question is, and I'm going to be a little contrarian here, are we expecting monsoon to do too much of that heavy lifting really?
No, so I agree. Monsoon not going to do heavy lifting, and even if it does, it will take time for it to fall in place, right? So it's all about expectation and all about how you react to the numbers. And that's where, of course, my own personal view is very different, but then you have to react the way the market's going to react. Markets definitely are going to look at this number and the next month number as the upside risk to inflation, and market's going to react to that definitely. Of course, one has to also look at it, food inflation, interest rates, does it really impact? So that's is one question. Our government's doing their own bit. In fact, today there was some newspaper article item saying that they are talking about importing 5 chunks of some pulses and all that, right, in spite of having enough buffer with the government. So to that extent, government is doing their bit, but yes, monsoon again, just like it is going to be taking time to get impacted, but if the monsoons are good, it will change the market mood. But at least till that time, till we see that good monsoon, the market mood would be giving up any hope on the rate cut. That's the market mood. I'm not saying that's my mood.
I'll just get to rate cut in just a bit, because I think that's the discussion and the commentary that market men and of course experts and members of India Inc. will await, and I'm going to turn focus to that in just a bit. But Mythili, I want to touch upon that important point. The 3-month expectation in the RBI's own policy was with an upside bias, and they expected that to rise. They said there's an upside bias to inflation. Let's talk about the elephant in the room that squeezes the chances of a rate cut even further, because even if the monsoon is good, we will see the impact only by September or October. So at least for one more quarter, we are ruling out a rate cut, aren't we?
Draw that conclusion definitely from these figures alone, for the simple reason that RBI's inflation survey is limited to a very small sample and is largely in metropolitan urban centers, not so much in rural areas. So though it does help, it gives you some indication, it's a guidance, one can't draw any conclusion completely from that alone. And if you look at the breakup of the data between rural and urban, then you see that the rural CPI, actually it is 6.45 and urban is 4.89. So clearly the impact of the inflation is more in the rural area than in the urban area. Now the rural consumption basket consists much more of food items than of services and manufactured items. So it is the food items that are driving inflation in the rural areas and thereby contributing to the large number that you have overall. And that has interesting possibilities, in fact, conclusions for the RBI's policy action. Because if it is food and if it is largely in rural areas, then RBI's action really makes very little difference at the first order. It's only subsequently in that food inflation spills over to general inflation that one needs to worry. So for now, the ball is firmly in the government's court, provided it manages the food economy well. And mind you, seasonally in the summer months, we always see a spike in food inflation. So I don't think RBI's hands are as tied as it would make it out to be. For now, we'll have to wait and see whether it continues this trend and whether we see a pickup in urban inflation as well, or whether it remains confined to food, confined to the rural areas.
Shubhada, I wanted to come in on that because we are looking at May CPI, fuel and light inflation at 2.94% versus just 3% in the month of April. So that's one part of the data. But like Mythili was pointing out there, food inflation is largely restricted to what the government can do with food prices. And so one should not lose a lot of sleep over what really happens on food inflation and whether it will restrict the RBI's elbow room. But my larger question is that while it continues to be the government's domain, in the past 2 years when we have seen inflation spike the way it did to double digits, we did see food get out of control first and it did have a spillover impact. We're talking about vegetable inflation at 10.7%, pulses at 31.5%. They almost have 100 basis points impact on the CPI data, don't they?
Yes, I think, and that is where not just the government, because government can do little about the vegetable prices. I think it's going to be the rain gods which are going to do a lot about the vegetable prices. If the monsoons, start delivering as the hope and expectation is, I think sentiment-wise also, if you go to the vegetable market and talk to any of the, vendors, that's exactly what they keep talking about, that, let the rain come and we will look at it. So I think government's role is very clearly in inflation items within food like cereals or pulses or staples, all the staples, and that's where the buffer stocks can be sort of eased into the market to calm down the price pressures. But insofar as current momentum is concerned, if it is purely vegetables, I don't think the government will have much role to play in reining in that inflation. Having said, I think it's going to be very critical to look at the other component of inflation which we have not really looked at, and which is the sticky part of inflation. Now remember that we are all talking of disinflation likely momentum for the food items maybe in the second quarter of the current fiscal year, because April to June in any case you see large price pressures build up for food, but subsequently with the rain onset we do see some of these items witnessing disinflation from say July to September right up to October. So that leaves us with the other component, which is the services component, and we have seen that has remained fairly sticky, close to and even slightly higher than 5% on many of these miscellaneous items like health, education and so on. Unless and until we see some softening in that momentum also, RBI is not likely to get a huge amount of comfort. That brings us to the rate cut story altogether. I think timing can be debated upon, whether it is August, whether it is later. Do we have enough room for rate cut? How much of room for rate cut? 25 basis points, 50 basis points. We believe that there is a room for rate cut, at least of 25 basis points, because we anticipate that it would have some softening momentum on inflation trajectory as we progress towards the second half of the year. But yes, this momentum between April and May is not comforting. We will have to therefore see the timing of a rate cut, if at all, if RBI does, get convinced about the disinflation story in the second quarter. But having said, I think the risks at this point in time are more on how monsoon is distributed and performs.
Actually, I think RBI will have to be convinced a lot more than some of us here believe. But Mythili, before I throw this to you, very quickly to point out to our viewers here, the April CPI has also been revised upwards. It was a 5.39 figure, has been revised to 5.47%. So also tells you a story of how inflation has been ebbing. Mythili.
Certainly, it is. In fact, inflation has always been part of India's story. In fact, 5%, 5.5%, 6%. These are pretty good numbers for India if you look at the track record. Jayesh, in fact, that brings me to the question of there's been reports today saying that the gazetted changes of the RBI, the amendment to the RBI Act, in that there is no mention at all of the target. Remember in the Urjit Patel committee, the target was 4% plus minus 2%. Given the fact that inflation is very much a part of the India story and the amendments to the Act do not specify the inflation target, and that is something that the government must decide. Is there a case for re-looking at the target and settling for 5% plus minus 1% rather than 4% plus minus 2%? Would that be more reasonable? Would that give us a monetary policy framework that is more attuned to both growth as well as keeping inflation under control? Jayesh?
Yeah, but Mythili, if you look at it, and even fact of late, even governor has been saying that, right? It's though target is 4%, but it is plus minus 2%. So when if you say 4% plus minus 2%, and if it is 5 or 5.5, but if you don't see the trajectory going up, they should be comfortable. The idea of 4 was about to be more on a comfort zone, just like how a lot of investment guys who will say, okay, fine, my rating is AA plus, AA, so I will not go below AA plus or something like that. So it is more of buffer building there. But if you have a trajectory going in that okay, it's even at 5.5%, but the next trajectory is going down. So this 4 plus minus 2%, that's what I think in recent times governor has been also clarifying that. So there is no set target of 4% by the government, but yes, it's a zone and the range which they are looking at plus minus 2. So from that perspective, whether it's 5 plus minus 1 or 4 plus minus 2, I wouldn't really be too much. It's about the next trajectory and next expectation is what you are looking at. That would really matter. And yes, of course, for that one has to take a stance, and whether it's 5 quarter and 5 half, and if you think that okay, 2 months later is going for a trajectory which is lower, one should not be that much concerned about it. But yes, as of right now, it's hard step of 4% in 2018, right? So that's as of right now. I'm not aware about that gazette today.
Jayesh, just hold your thoughts there, because I want to take another question just on that line with Rupa Rege here as well. Rupa, I mean, that's a very valid point that Mythili is making here, whether it should be plus minus 1% or plus minus 2%. My larger question to you is, given the numbers that have been reported today, and I know monsoon can bring in some amount of comfort, but we've seen the comfort from commodity evaporate. We've also seen the disinflationary trends really wane one after the other. If I may ask you, do you believe by the end of it, and because the RBI has already put out in its monetary policy the 3-month-old expectations, the cost factor that they've spoken about, do you believe the RBI will perhaps be forced to raise that 5% level by the beginning of next year? Is that a possibility at all?
I think so, because I feel that on an average it will be very difficult to contain inflation around in the neighborhood of 5% in FY17. My own estimate is that for the factors which you mentioned, and also 7-8% rupee depreciation, which is also creating a lot of cost pressures, and we have started seeing it. And you see, even if there was decoupling between producer prices and CPI, I think going forward, that they will also try to move more closely. So we cannot rule out the possibility of inflation spiking again, and RBI has been saying it again and again that they would be convinced about inflation management only if inflation comes down on a sustained basis, and that is not happening. So I personally feel that, you know, RBI's focus on liquidity infusion and effecting transmission through financial markets like CP markets or corporate bond markets, I think it is going to bear more fruit than focusing on transmission through credit segments, because we know that there are a lot of structural problems in the banking industry, and all rating agencies, analysts have been warning that it will take anywhere between 12 months to 16 months for banks to come out of the problem of stressed assets. So we really have to have a very stable and firm and sustainable recovery for that to happen. Until then, RBI would prefer to remain in a cautious zone so far as rate cuts are concerned.
Manoj, you know, one of the criticisms about the RBI's liquidity management was that as long as inflation was, you know, high and seeming to move up further, the RBI believed in keeping liquidity deficit. It was only because when inflation started coming down, the RBI decided that, okay, we will make liquidity neutral. Now that inflation seems to be picking up again, will the RBI again go into deficit in its liquidity management with all the repercussions that it has for an economy like ours? You will find interest rates not coming down, you will find a lot of other issues with banks, you will find bond yields all being affected. So will the RBI again go into that liquidity deficit mode with, as I said, not very happy consequences?
You know, I think moving from a liquidity deficit mode to a neutral mode was a huge move from an RBI perspective, because it was not merely related to inflation ticking higher or interest rates being higher. It was also a departure from the Monti Committee report, which, you know, recommended a 1% shortfall versus NDTL, etc. So I think that was a huge shift. Now, I would be surprised if that move was really ad hoc and, you know, at the first signs of an uptick, they moved the other way. And I think that's what I would like to highlight. I think Rupa mentioned this earlier as well, and I would like to second that, you know, I think we are too focused on rate cuts and how they're related to the inflation movements. I think we should also focus to a great extent on what the governor said last week, and which has been playing out over the last couple of months. Really speaking, they've done two very important measures. One is MCLR introduction. I haven't really seen MCLR coming substantially lower than the earlier base rate regime. So to that extent, Governor mentioned that he would track and RBI would pursue and see how MCLR was really playing out. So to that extent, rate transmission would happen a little better. The other thing that has been done is the repo corridor has been narrowed to 50 basis points. Once you move to neutral, and you know, neutral is very difficult to maintain, so you end up having surplus liquidity at some point, you might very well see 6% on the overnight rate rather than 6.5%. And that would in effect mean that rates are going to be easier and lower than, you know, just warranted merely by rate cuts or, you know, where inflation is. So to that extent, I do think RBI is committed to ensuring liquidity is going to be neutral or slightly easier. Also, do not forget that there is the FCNR redemptions round the corner. I do not think that RBI or any of us would like the system to be in a fairly significant deficit approaching into that, because that would substantially disrupt money markets and consequently debt markets, the government's borrowing program, etc. So I think, I don't know whether that really answers what you asked, Mythili, but my guess is I think we should focus a little bit away from merely rate action, but the other things that RBI is doing.
Absolutely, and I think RBI will continue to be in the news. It's not just FCNR, it's going to be Janet Yellen who will act whenever she does, hopefully soon, and end the uncertainty, and I think RBI will be tasked there as well. Mythili, let you have the last word on this, and then just to make this a little more big picture in that sense, 5.76% CPI, all right, but a raging debate on growth numbers and how they're actually lower than what is being reported. Where does the focus of policymakers, including the RBI, lie right now?
It's become an inflation targeter. Post the Rupa Rege Committee and the government formally accepting it and making the amendments in the RBI Act, I think the RBI's focus will be almost entirely on inflation, if not entirely. And that actually, I'm a bit of an old worlder in that sense. I do think that the RBI should look at inflation as well as growth. Unfortunately, perhaps the focus on inflation alone does mean that growth perhaps suffers, quote unquote. That's not very good as far as I'm concerned, but that, of course, I'm in a minority over there.
All right, you're never in a minority as far as startling views are concerned. But Mythili, thank you very much for joining us, and it's a big thank you going to Shubhada Rao, Rupa Rege, Manoj Rane, and also Jayesh Mehta for being with us in this edition as we discuss and debate the CPI numbers well above the RBI's comfort zone at 5.76%. Is food prices a passing phenomena? Can the government rein it in, and will this impact the elbow room that Raghuram Rajan will eventually have in cutting rates? Thank you very much for joining us on this very special edition.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.